ranting's not even the issue. It's sometimes I struggle to form a cohesive, coherent sentence a lot of the time. Well, ladies and gentlemen, we have someone who can do that joining us on the other side of the mic. From August, previously you might know it as Fractal, Kantorovich. Thanks so much for taking the time. This isn't your first rodeo appearing on the scoop, but I think it's your first time in your new seat. And
it sure is.
We're excited to get into everything. So obviously folks may be unfamiliar with what you're working on and what you're all about. They maybe have been living under the proverbial rock or paying too much attention to the slings and arrows of the new administration. So give us a rundown of your journey. And then there's a lot of stuff that we're going to get into.
Yeah, I can't wait to dive in. Thank you, Frank, so much for having me on again. It's any conversation with Frank is going to get into the nitty gritty, so I'm buckled in and ready to go. My quick background: so I started my career on the banking capital markets side of the business before entering into TMT equity research, and then finally making my way into crypto in 2018 at Patera Capital. Then I was part of the founding team of FalconX, so crypto prime broker. Joined Seed and left right after we raised our Series D. And I got very lucky. I transitioned out a month before the FTX collapse happened. So, had a lot of concerns with CeFi. We can dive into that if you'd like, and lack of transparency there. August, our new company, which we're very excited about, is focused on bringing prime services on chain. We have a smart contract wallet that we've built in order to support and facilitate all of that. And then we've also launched Upshift. So that is our retail company and what we're focused most about, tokenizing all yield on chain and making things really simple. If you think about on chain finance today, multiple clicks, multiple chains, very many protocols. Our idea is to simplify all of that in one place. And that's what we're aiming to do.
Uranium.io, an entirely new marketplace for trading uranium and powered by Tezos technology, is live. As global energy demand rises and nuclear power becomes a key player in decarbonization, demand for U3O8 is increasing. But up until now, its access to retail investors has been limited. Unlike other precious metals like gold or silver, the traditional uranium market has high barriers with minimum lot sizes of tens of thousands of pounds that's limited retail participation. Tokenized uranium breaks these barriers, enabling anyone to own physical uranium with accessible pricing and no need for complex storage. Investing in uranium is now widely accessible, and you can learn more at www.uranium.io. For crypto and DeFi professionals looking to contribute to a team committed to innovation in digital assets, Fidelity Investments is now hiring. Why Fidelity? For starters, they've been exploring Bitcoin and blockchain since 2014. They were the first traditional asset manager to launch a native crypto business and among the first to launch a Bitcoin exchange-traded product. Innovation is in their DNA. Fidelity invests in their talents by supporting and developing associates through continued education opportunities, casual crypto-focused discussion groups, and on-the-job experience of working with new technologies. If you want to work on cutting-edge products and explore the new frontier of DeFi and blockchain, Fidelity is for you. Their products continue to improve and evolve, staying ahead of this rapidly changing digital asset landscape. So go ahead, explore Fidelity Crypto Careers today by going to crypto.fidelitycareers.com to learn more. That's crypto.fidelitycareers.com. Fidelity is an equal opportunity employer. When you think about the composition of our crypto capital markets, you would think in the wake of that credit crisis that there'd be a deeper penetration on the institutional side into decentralized credit, decentralized exchange. But that didn't necessarily happen. Whilst those rails held up and were quite strong and robust relative to the centralized counterparties, and obviously more transparent to your point, what's sort of holding us back from a more decentralized future from a capital markets perspective?
Yeah, I would break it into a couple buckets. The first is as it pertains to how you define institutions, we tend to get caught up in that nomenclature pretty often in crypto. I would say, if you're talking about the institutions such as, retirement funds, family offices, large multi-billion dollar asset managers that are buying, let's say, the BlackRock iShares, those institutions are getting involved, but they can't touch DeFi directly due to regulation. And so, that's an area that's always held those folks back. A lot of the banking participants, at least in the United States, we've seen a lot of activity pick up on
Mm,
chain with banks overseas. But regulation is really the big one. Where we have seen them engage is they are very large LPs of crypto funds. And so while they directly are not facing DeFi, they are indirectly facing DeFi. And so the AUM of those funds has significantly risen over the last 2 to 3 years, and largely in part to more of these institutions getting involved. And so I think people tend to overshadow that because you want to see the big headline of the bank touching DeFi directly. You want to see the retirement fund touching Aave directly, as you mentioned. But they can't necessarily do that. They can definitely invest in a fund who can. And so we're seeing a lot of that. And then on the, DeFi piece directly, I think you're still seeing quite a bit. For example, from our position, a lot of our lenders today haven't. We're the first counterparty they've lent to since the collapse of a lot of the CeFi players, whether it's Celsius, BlockFi, and in part to the very strict security measures that our smart contracts have and full transparency on how loaned assets are used. But to your point, I would say there's definitely a dichotomy between these two on the expectation of the large headlines coming on chain versus what they can or can't do, and then who's actually engaging on chain today.
that's really well put. I think one thing that has, if you were to sort of take a look at the penetration of Wall Street into crypto, obviously it's expanded. Maybe not into the DeFi side of things, but they have like this proxy exposure via maybe the crypto funds they're investing in who have a bit more flexibility into dabbling, as it were. But overall, just zooming out, right, that institutional exposure to cryptos, um, an order of magnitude larger compared to previous cycles. And one thing that I'm curious to get your take on is the impact of that institutional exposure on the different boom and bust cycles that we've seen, right? Because it doesn't look like that's changed that much in terms of the same cascading liquidation blowups that we see in terms of um, the volatility that we still see. You would think, or I would have thought, that with more institutional capital would come a dampening of these weird idiosyncratic elements of these crypto markets, but they haven't. It's still seemingly just as volatile, and leverage boom and bust cycles seem to play out with just as much frequency. Do you think that that changes on the micro part? And then, of course, the 4 year cycle that we typically see. Um, or is that going to continue to sort of be a pesky, idiosyncratic element of this market?
Yeah, I think the devil's in the details here. And so looking at the numbers on the micro side of it, we saw the largest liquidation event happen on
I
February
know.
2nd in crypto. But if you actually dial into the details, anyone who's been in crypto for a while will tell you that it was nothing like Black Thursday and Friday of crypto in previous cycles. And so the reason it was the largest is because the notional dollar denominated value of crypto has gone up, not in nominal or notional BTC terms. And what I mean by that is that if you actually just look at implied volatility, the implied volatility is actually down significantly from where it's been in pre 2023 numbers. And so, a huge part of that is, exactly as you mentioned, is that the holders of Bitcoin have completely changed, and the participants have changed and become more institutional. So if we look at just taking, this month, and we look at who the top 10 holders of Bitcoin are, today the top 10 holders hold 19.75 million of the 21 million capped Bitcoin
Mm,
supply. So roughly 94% has been mined. The top 10 holders, excuse me, hold 20% of that. So 19.75 million is out there of the 21 million, 94%. And of that, 20% is held by these 10 members. Those 10 members include, and going by order of magnitude, Coinbase, Binance, BlackRock, MicroStrategy, Bitfinex, the US government, the Chinese government, EOS, Tether, and Zappo. And so the two names that really strike out to me that are different here is BlackRock is number 3 and MicroStrategy is number 4, but even Coinbase as number 1. Because if you think about, the participants who are buying Bitcoin, leaving it in Coinbase custody, or buying the Bitcoin ETF and using that IBIT potentially as margin, those participants are far different than our traditional, call it hodlers, that we've seen historically in the last, call it 8 years.
I see.
And I would really dig into that in terms of investment strategy. So if you think about if someone has a portfolio and they're targeting 2% of Bitcoin allocation, if Bitcoin drops, then the share of the portfolio also drops, and the manager therefore has to buy more Bitcoin. Conversely, if Bitcoin rises, then now the BTC share is higher than 2%, so the manager has to sell. So basically, when the market goes down, institutions buy. And then when the market goes up, the institutions sell. And so inherently, BTC implied volatility has dropped. And you're actually going to see that, and I'll give you my last data point on this, is that notably Bitcoin is now less volatile than 33 S&P 500 stocks as recent as 2023. And there were in total, um, I more data points around even not just S&P 500 stocks, but also Nasdaq stocks and others that are far more volatile than Bitcoin. So that that volatility number is decreasing. I would say the headlines perhaps aren't necessarily framing it in that way.
You know what I think it might be? You know what it might so the point obviously is that we have seen a decline in volatility as the concentration of Bitcoin being held among institutions increases. But maybe there's this sort of feeling that maybe this sort of like anecdotal sense of volatility derived from the fact that in recent like over the past year, there have been so many macro events happening over the weekend, whether it was news or headlines out of Israel, or even recently, right, with Trump talking about tariffs over the weekend. And so the news hits and is digested first by crypto markets because everything else is closed. And so it seems like our markets are more reactive, but they're not necessarily more reactive. Well, at least thinking about Bitcoin specifically than other stocks. It's just that this is where on a weekend, a macro hedge fund can actually express a view or hedge or speculate or whatever have you, or take some risk off the table, etc.
It's a fantastic point, and I don't think it's talked about nearly enough. And I'm really glad that you mention it because you're absolutely right. In this administration, so
So
much.
proud of myself.
Yeah, but it's true, it's so important. So much news has hit on
The
the
weekend.
weekend and, on days where, maybe it's a federal holiday and the markets are closed. And to your point, these managers have to express their views or hedge their portfolios in some way, shape, or form. And there is a lot more correlation with Bitcoin and, macro markets now. And so you're seeing that being expressed in crypto, and not only, in the US, but also, especially with Asia, we're seeing a lot more of that activity really spike up where it
Hmm.
had quieted down over the last couple of years. And so that's really exciting. And I think it's, my hot take is that it's going to move markets, traditional markets, to become more 24/7 over time. We will at some point get stock trading on the weekend just because of how, news travels and when things are being announced. But that'll take time. Until then, crypto is going to be where people continue to show those insights.
I will say though, it sometimes does feel like there was a lot of memes on this point. With the most recent tariff related drawdown where oh geez, I'm sure you saw some of them where it's like the great thing about crypto is in anticipation of the market opening down, it trades down lower, and then it will also still trade down even lower when the market does in fact open lower. Um, so to be fair, like some of it's kind of just um there's a difference between our interpretation or how things feel and like what the actual raw data suggests. But there's no doubt, right, that this intertwining element of the market with sort of increasing institutionalization of the market has resulted in the things that matter being the same things that matter um, to traditional markets. Right. I
Mhm.
mean, when we think about this morning, the CPI report was indicating that inflation rose unexpectedly higher in January, resulted in a drawdown across global equities and crypto. Feels like the specific crypto specific headwinds appeal to be ameliorated to an extent with the regulatory environment shift, but now this is in the driver's seat.
Yeah, I would say, it depends on the narrative you're trading on and your investment thesis for the space. To your point, if you are a systematic fund or market neutral, then we are very much in the 4 years of headline trading again. And look, I think people tend to have short-term memory sometimes and forget that the first 4 years of the Trump administration were exactly this, where trading was felt very emotional and very reactive to headlines, and we're now in the tariff and inflation cycle, where there's just a reaction to every announcement that comes out weekend or weekday. But if you think about it from a momentum standpoint, the Bitcoin's inflation is going down. And so to your point around the CPI, right? You have the US dollar, CPI is around a little over 3. And so it's historically high. And the US dollar has a limited supply. Here we have 21 million, of which 94% is already mined, and inflation of that's going down. And so, with Bitcoin with less than 1% inflation, gold with roughly 1.7% inflation and annual supply increase, and the CPI and US dollar, which we mentioned, Bitcoin as a momentum play is still looking like a really great reserve asset and a hedge against inflation. So I think it just depends on what narrative you're trading on. But without a doubt, I'd be lying if I were telling you that, to your point around the memes, where we trade lower, market opens, we continue to trade lower, and we're trying to figure out where the market's holding. Are we holding in 90K? Are we going back to 70? The whiplashes are very real. And it tends to impact, your day-to-day, your
My
day-to-day,
my life,
your life.
my day-to-day happiness, my day-to-day
Right.
sanity, my day-to-day
Right. Right.
ability to get out of bed in the morning. No, I'm just kidding. Well, when you think about those specific tailwinds, you mentioned the attractiveness of Bitcoin as a reserve currency because of or reserve asset because of these attributes. And I think we've seen over a dozen states come out, and we've also seen Czech Republic come out and say that they want to create some form of reserve. How significant is this, and how do you anticipate this will play into the bull case for Bitcoin specifically?
Very significant. And, I think what we're seeing in the United States is this almost competition between, and the beauty of state versus federal, but this competition between the two, right? You had Trump announce that he wanted to make a Bitcoin reserve. Going back to the Trump headlines, now everyone's trading around the probability of that reserve
Mm,
actually getting pushed. Polymarket, at the beginning of the month had it at 44%. It's now 12.
mm.
And so these states are kind of taking matters in their own hands and saying, we're going to create a reserve ourselves independent of the Federal Reserve that might be on the table. And so these 14 states have said, here's kind of our plan of action. And we're going to move at it at different paces. And again, it just goes back to there's 21 million of fixed supply. So at some point, everyone's going to own the total supply amount. And then it's just a question of supply demand. But if you think about it more globally, to your point on the Czech Republic, it at some point it becomes a geopolitical play here. And I'm very sure that the administration is thinking about that as well. Where if you have a limited supply of Bitcoin, at what point do you want the United States to own more than China?
Mm-hmm.
If you look at the countries that own the most amount of Bitcoin, it's the US, China, UK, Ukraine,
Mm.
Bhutan, and El Salvador. So, it's really this race between some of these different countries because at some point, you want to both be a large holder of gold, US dollar reserves, Bitcoin. And so we'll see that race play out as well, which for everyone who holds Bitcoin is much better for us too.
I mean, it's difficult to imagine a world in which we would want China to own more Bitcoin than us. And then you get, into an interesting arms race type dynamic, which sounds very bullish for our respective bags. Um, so another meta of this cycle that feels different is this meme coin Cambrian explosion, and Trump's meme coin kind of caught a lot of people by surprise. What do you think it means for the industry? Is it good or is it good? Is it bad or is it more nuanced?
Yeah, I would say it's more nuanced. And look, we were both at the crypto ball at the beginning of the year, and the comparisons between being at that event, how both institutional but or it was really the first time you had a sitting administration or come in, about to come in sitting administration meet with all of the operators driving so much of crypto in the space. The dichotomy of that, and then the Trump token launching, at the same time for really retail investors, totally missed it. And I think, I wouldn't be surprised if that was intentional to try to really expand the user base. That's my view. But, I think what it signaled more broadly to the market, I'll talk about that and then I'll talk about what it means for the space. But more broadly, it signaled that, you know, this is a new form of capital formation. It used to exist in the form of ICOs, and now potentially it's back. And what that means is really, if you want to raise capital, if you want to bootstrap customers, you can do so in this token mechanism. And so if you really push the boundaries on that, you can imagine a world where, you know, New York City wants to raise money in order to repave all of the streets, and maybe they launch a token to do so. Or, the universities want to build new facilities for students. Maybe they launch a token for that. Netflix. And then, of course, the proliferation of stable coins facilitating all of the transactions between. So I would say that's my optimistic view. But as it pertains to meme coins, I think typically the who you are selling into tends to also be retail. And so unfortunately, what we saw with the February 2nd liquidations is that all coins got absolutely decimated. And so there's just a huge dispersion of returns here that I don't think we talk about enough. Where perhaps some of the institutional funds made a killing on Trump coin, but if you're a retail user and perhaps this was your first time onboarding to crypto, you have Phantom, you went through Phantom, it was a great experience. Now you lost 70+% on these tokens, and you're like, you know what?
Rugged,
This,
totally rugged.
yes, this was terrible. I had a terrible experience. And so I think, like, really what the industry is missing right now is despite retail activity surging at the beginning of the year, despite Coinbase seeing a spike, an 80% spike in spot volume, despite all of that, we don't have the narrative here for real product market fit outside of gambling, which is fine. Sports gambling is a big thing as well, but the user experience is still pretty bad. And I think what we're missing still is like the Axie Infinity, is the dApps, decentralized applications that just we haven't seen as much of in this current cycle that we're at least focused more on.
So you know what tomorrow is, right? Put you to the test here. Well, at least I think it's tomorrow. Maybe it's the day after. Let me check. Where is it? Where's the date?
I was
Coinbase
gonna
earnings.
say,
Are
oh,
they not
oh boy.
Coinbase? Coinbase earnings are tomorrow, right?
It is tomorrow.
This is going to be an earnings period to watch for sure. But we have some initial data in terms of this is the average research estimates with it looks like consumer transaction revenue for Q4 is looking to be well, total transaction revenue 1.1 billion, I guess.
hmm Yeah, I think they're expecting revenue up over 100% year over year for Q4.
And I only brought it up because one of the questions we were looking at spoke to the retail activity surging with, Coinbase's spot volumes spiking by 80%. So we'll see, we'll get an indication tomorrow about the extent to which that momentum will continue, but I guess we can ask you, do you think it will?
Yeah, it's a good question. I think it really depends on one, the administration. Again, retail is also very reactive to it. And two, what are the next narratives? Are the next narratives going to be, we've talked about meme coins, but someone put it very well to me once, which is, you can only have the first once. And so you can only be the first politician to launch a meme coin and then the first artist to launch a meme coin. We saw David Portnoy launch a meme coin, and at some point that narrative it quiets down, and you aren't as excited or see the volumes on the second, third, and fourth. And so, I think people are looking for what that next piece is. Um, yield is always a big one that captures retail. But a lot of companies that have been funded recently, and we're seeing more of that spike up, is in the decentralized application space. I think, in the last 4 years, so much of venture capital really went into infrastructure, ourselves included. And now we're seeing that change into decentralized applications, use cases. Again, how do you capture retail interest? I mentioned Axie Infinity again, but it was really like gamified on-chain games. And maybe it's just more hyperliquid. Who knows?
It was the poster child was, of course, Steppen.
Step in. Yes, I had a couple sneakers. Those are really cool. But we haven't. I don't know if you've seen it on your end, but I just haven't seen those applications come back in this cycle, and it really feels like the missing link here for actual use cases.
I 100% agree. I mean, but it's hard when you think about the value that can be. I mean, it's easier to hit that unicorn valuation on a new layer one because that's where all the value accrues than if I were to just start some stupid application. I'm just kidding.
Look, you say this. However, all of the tokens that have launched on Binance since the beginning of the year, all the perp launches, excuse me, are all down 30 to 90%.
Oh
So,
yeah. But that goes back to this point you made about capital um whatchamacallit, around the our market is so bad at like doing a proper like roadshow and thinking through like I don't know if meme coin is one way to do capital formation, but the existing way in which we go to market with some of these tokens is just super unrefined and not very sophisticated. No offense, Barachain. I'm sure you tried really hard, but when you see something like that, that just speaks to not the value of their token, but the inability to really go to market properly and have buyers lined up, to have institutions lined up to create an equilibrium between the sort of early sellers or the early employees who will sell and the new buyers in the market. And this is something that I've talked about or I complained about. Um, ad nauseum.
You're spot on. But it takes, in the traditional world, you have an investment bank that's managing the entire process for you.
Mhm. Yeah, and there's a book building process, and there's securing institutional buyers. Um, Now we just have these imbalances.
The only difference in crypto that has worked is, these product market fit companies that
Mhm.
have a fully sustainable business and then launch an airdrop. So, back in the day was Uniswap,
Yeah.
and then most recently Hyperliquid, right? The Hype token launch was fantastic. And it really, really shows that if you have product market fit, you have dedicated users, you have people who like to use the product on a day to day and aren't necessarily there for the token, and you create that wealth generation on chain, it continues and stays consistent. And people have gone out and bought Hype just based off of that, airdrop event. And I think that was really, really well executed. Major shout out to that team on doing, a fantastic job. But really goes to show that, if you have product market fit, you have a product that works, it's a lot easier to value the token than, on technology that perhaps is there, but the applications on top of it haven't been built yet.
I think that's a good point. I mean, like, I think everything, there's a degree of nuance to these things. And I think when we look to the future, we're going to learn from the mistakes and the accomplishments of various projects, and that'll get us closer to Valhalla, as it were. But you're 100% correct. Um, but I do think that a lot of people don't take the time to think very thoughtfully about these issues.
Yeah, and it unfortunately leads to pump and dumps. And then, going back to our earlier conversation, that's where retail gets hurt. And
Hmm.
so, it's not great for the space. It's not great for the new users. And it's not great for the industry at large. And so, ideally, to your point, we have more hyperliquids come out over time. But what we are seeing, despite all that, is that the price discovery is happening on chain. And
Hmm.
so, there are silver linings in all of this where, even if we look at where all that discovery happened, whether it was hype or it was meme coins, it didn't happen on centralized exchanges first. It did not happen in CeFi. It happened on DEXs. And that personally makes me very happy because
I
I
can imagine.
I mean, that's been our guiding north star, is that, things will move more and more on chain over time, and we are seeing that, although slowly, but it's certainly happening.
And these venues, if you want to call them that, just perform. I mean, I don't know if they can handle the same amount of size, but when you look at how they perform during these massive liquidation events, right? They they perform very well during these market turndowns. What does that say to, or what does that tell us about the resiliency of DeFi during these drawdowns?
I mean, I think it's time and time again, we've seen that same resiliency. We saw it with FTX.
Hmm.
We saw it, 3 or 4 years prior, and consistently DeFi works and it's fully transparent. And when it perhaps, on Black Thursday in March of 2020, um, when COVID happened and that triggered liquidations, you had a 48% price drop in ETH and DeFi worked. Now, when with what we saw with Feb 2nd, you saw that Aave, for example, processed over 210 million liquidations in the market downturn. And by comparison, you know, Aave processed between 2020 and 2022 roughly the same amount. So it's the size is enormous. And despite all that, DeFi performs seamlessly. And so I think, we maybe don't always hear and see the blowouts that happen in CeFi. Um, but they certainly do happen. We can't verify on chain who has lost money on balance sheet, who now has higher and much larger liabilities on their book. A lot of CeFi now has a prop desk and takes risk on their derivatives desk. And so you can't verify any of that. And I think you'll continue to see again, people tend to forget, right? We have short memory span. And so people, started to take more risk on during FTX. And now with what happened in Feb are starting to ask the same questions, which is, all right, how much did you lose on Feb 2nd? And were you well positioned? And what's the size of your book? And if the counterparty says, I don't need to show you, then, perhaps that's not the right counterparty to be trading with.
No, I think that's really well said. And it's a lot of those. It's a lot of those unknowns, right? It's not necessarily when you think about transparency. Yeah, it's not an issue until it becomes one. So at first glance, it doesn't really seem that superior to engage with DeFi because the CeFi works until, of course, it doesn't because
Right.
there's a blow up.
Yeah.
And
And
those,
this is really important that you brought it up because Luna collapsed in March. FTX didn't go bankrupt until November.
mhm. Yes, it's easier to paper over the cracks.
Exactly. Or try to trade out of it. But these things take time, right? And those cracks grow. And, after Luna, the market took a pretty big bear turn. So it was hard to make up any trading loss that you might have incurred in doing so. And so, with DeFi, it's all transparent, it's all on chain. If you see someone, if Aave, for example, had taken on some bad debt, you would have been able to see
You would
that
just
and
see it.
analyze exactly whether or not you wanted to move your funds off and use a different counterparty. And so, at least for the folks we've spoken to, people very, very much understand how important DeFi is. It's really just a regulatory piece, and we've seen since late Jan that those conversations have sped up dramatically, and almost to the point where it feels like every person I'm speaking to on a call, because these conversations now went from oh I can't have this discussion to let's have all of the discussions, and we're all exhausted because suddenly the tap has been turned on again and everyone wants to start a DeFi project, some sort of initiative where even if they fork something
Internally
um
at at these CeFi firms?
at at banks. I'm talking
Mm,
much broader. I
mm,
think a lot of the banks that we've spoken to are already engaged in DeFi in some way, shape, or form in a permission sense.
mm.
And so, every bank, every large bank has someone tasked to work on this. And now those conversations are just sped up.
Yeah, I think that, like, as long as there's guardrails around it,
Yeah.
then it's a pretty appealing infrastructure to build on.
Yeah, that's where we play a big role. Because to your point, you want to be able to control whitelists. You want to be able to control how funds are used. You want to be able to get alerts for hack risks and asset movement and smart contract changes. You want to be able to really control both asset movement on a token level, but also on a protocol and chain interaction level. And we're able to do all of that while still giving the institutional experience. So we found that people really appreciate it because you are looking for those kinds of guardrails in an open and transparent system.
What does the introduction of AI agents mean for our capital markets?
Oh, I love this topic. So, this is what really, really excites me
Mhm.
in terms of the innovation in the space.
For this one, I have to pull up your notes, I think, because we really got jamming.
Yeah, yeah, absolutely. I could jam on this for a very long time. But I will say that sometimes it's hard to think about all the innovation that's happening when you have the market whiplashes. And so this is a topic that personally really excites me. There's been so much work on this that's come out in the last 6 to 8 months. And so the way we're using AI agents today
Hmm.
is
This
for
is under
example,
Upshift, right?
correct, correct. Yeah. So we, under our Upshift brand, have launched a vault that systematically optimizes Ethereum returns across blue chip lending protocols.
Hmm.
And the AI agent will basically monitor all of the eligible yield opportunities and rebalance between them. And the way you can interact with the agent is basically just ask them any questions regarding the vault. So, what's my current allocation? Why did it not allocate to a specific pool?
Mm.
All of the customer service questions that tend to come up. How much TVL grew yesterday? How much did the APY change? Questions that I don't think people realize, but when you're engaging in crypto, you're not going to go to a blockchain search link or an ether scan, look through transaction logs, and actually be able to comprehend what's going on. It's very complex. And so having this agent respond to you in a Telegram chat
I don't
is a
know.
no brainer.
I think I could do it. I think I managed.
It's all right. I'm going to put you to the
And so
test, but
what's the I mean, effectively it's helping to amplify your returns by making um better informed decisions
that's
than you
correct.
could
So,
make that I could make.
absolutely. Yeah, it's able to manage a number of different metrics and then move the assets accordingly. Now, where the agent piece comes in is it also lets you interact with it directly as opposed to having to send systematic signals. So
Mm.
you don't necessarily need to be an engineer or a quant in order to send API calls to this algorithm in order to rebalance. You can basically say in plain English, this is what I'd like you to do, and this is how I'd like you to do it. Now, the important piece about these AI agents, and I think a major gap we see today, is that to your point around guardrails, if you do not have the proper guardrails, you are not going to send $10 million through an agent. It's just absolutely not going to happen. Or you're not going to let an agent execute without guardrails and suddenly get 30 bips of slippage on chain.
Mm.
That's not going to happen. And so what we've done is because we already built the technology to include all of these both security restrictions, whitelisting restrictions, and trading restrictions on the account, the agent is pretty limited in what it can and can't do. So you bring pair the two together and suddenly you have the guardrails you're comfortable with the ease operationally of having to actually manage one of these strategies.
Well, I'm gonna give it a try. I don't have any I don't have any agents. I just have my helpers doing my bidding, I guess, but they're all real. They're all flesh humans. But once you get like some Frank AI agents going, I think I'm gonna be
Watch out,
unstoppable.
world.
Yeah,
Watch out.
literally. So
Yeah,
what should
it's
what's on the horizon for you guys next? What should people be paying attention to, and if they want to learn more, where can they?
Yeah. So, for Upshift, we're tokenizing all yield. So, in our opinion, any asset that you have should be earning some form of yield. We've seen that with stablecoins, we're looking to expand that. And so, if you're looking for any sort of yield on the liquid asset, check out our Twitter at Upshift underscore FI, or my Twitter at AYA underscore Cantor. And then in terms of what's next for us, it's continuing to build out more seamless one click trading. This is a North Star we talked about for a very, very long time. It is very difficult to engage in DeFi today, in trading at large, but also especially in DeFi. We want to get to a point where you get one click trading. And we're doing a lot of work with transaction batching for multiple legs of a trade, a lot of work with AI agents for operational efficiency. And so we're going to see more of that. And yeah, hopefully user experience becomes far more seamless. So we do get that wave of both institutions and retail coming into the market
Soon.
soon.
Well, thanks so much for taking the time to join the program.
Thank you, Frank. It was a pleasure always. Appreciate the
Pleasure was
conversation.
all mine.